I'm Michael Rogan, the founder of Rogan and Associates Financial Planners. I want to share with you today what I have learned over the 30 years as a financial planner. And that would be, first and foremost, ignore the media. Turn off the TV. Don't watch the news. Put down the newspaper. You know, Mark Twain once said, if you don't read the newspaper, you'll be uninformed. If you do, you'll be misinformed. So this isn't a new thing. This has been going on for hundreds of years. Successful investing is a lot more simple than you might think, but it isn't easy because we are constantly being bombarded with misinformation, or as I was calling it the other day, statistical truths but moral lies. There are facts that are presented, data points that are presented completely out of context in the media all the time, and then the conclusions that are drawn, in fact, I'll give you some examples, are exactly wrong. So one of the things to know about long-term successful wealth building with your investments is you cannot time the market. It seems like the most obvious thing in the world. I'm going to buy it when it's low and sell it when it's high. But there's a reason everybody, every expert always tells you not to try to do that, because no one can do that. Successful wealth building is a very emotional thing, aided and abetted by articles in the media that are designed to address your emotion or get you emotional about things. So let me give you this example. We kind of inherently know this. When the masses are always doing something, they're rarely, if ever, right. Think about everything you've ever experienced in your life. When everybody likes a particular type of investment, it means it's very expensive. They're in the investment, they've bought it already, they're telling all their friends about it. If you want to think about in the mid-2000s, think about real estate. Think about condos on the beach around Florida. At one point in 2005 or 2006, they'd run out of people who wanted to buy them. But at that point, they were the most popular they'd ever been. But there was no one left to buy them. So at a point of peak popularity, they pretty much had nowhere to go but down. So with that in context, this week I found a couple of articles on the web through Yahoo Finance or Investors Business Daily. And the articles talk about why the stock market's current rally has to end because investors worldwide are holding more money in cash right now than at any time since right after the terrorist attack of 2001. With my 30 years of experience, just that conclusion was the most baffling thing I'd read in a long time. Individual investors have most of their money sitting in cash, more money than ever sitting in cash, and that's why the stock market can't go up. Well, the reality is that would mean that's a lot of money that could come in the stock market. The last thing it would portend to me is the market would have to decline. The next article said gold funds, gold exchange traded funds, have more demand right now than at any time since the crisis of 2009, the panic, the visceral panic we all felt in 2009 when everybody fled stocks worldwide and ran to gold. So their conclusion also was the smart people are in gold right now, and therefore the market should not go up again. Now, again, you can't time the market to build wealth, but maybe I could educate you on how to be less emotional about your money. One of the things you should always know, and there's some different adages. There's an old adage out there that we should all be greedy when others are fearful, and fearful when others are greedy. And that's a pretty good point. If you think you know a lot of folks that are very optimistic about the stock market, optimistic about our country, optimistic about the economy, then maybe you should be a little bit worried about things. But I want you to think back at times that right before big market declines. Think about the year 2000, if you can remember back there. The year 2000, dot-com stocks were all the rage. People were quitting their jobs to become day traders because it was so easy. The market was just going to go to the moon. At that point, everybody was all in. Again, the market didn't have much more upside at that point because everybody had already bought, not unlike the condos of 05 or 06. Today, I think you'd agree, you talk to your friends, your family, your colleagues, nobody's optimistic. And by and large, nobody's in. But every article that gets written says, beware, there hasn't been a market crash in a while, one has to happen. It's not how this works. So you can't time the market anyway, don't worry about it. Your allocation should be put into place to address your needs and your goals and what your money needs to do to you. But right now is one of those times over the 30 years I've been doing this that I would have very little fear of a major market correction. In fact, I would tell you that there's so much money not in the stock market worldwide right now that it's likely to me that we're at the beginning of a long-term trend of above average returns for stocks worldwide.